The idea here is that you don't see this just as another webinar. This is intended to be a lab today. So you'll be getting some deep insights and things that are actionable. At the end of this, you'll have some action that you can take based on the insight you get today. I'm Jeremy Newlick, by the way, and I'm fortunate to be a partner here at Boulder Futures alongside Coleman, who will be presenting today. He's a certified exit planner, all around good guy, and just a brilliant business mind. And is a lot like you all who have joined this meeting. He doesn't have a background that consists of consulting. Most of what he comes from is rolling up his sleeves and actually helping a logistics supply chain company to build its value. So that's what we're going to be getting today. Those of you who responded to the survey that went out ahead of time, we did see that there was a big variation between the kinds of multiples you might be seeing in your business, but no one who responded had ever had a formal valuation performed on their business. So you will see some content today that is specifically for you. It's intended to, while it might seem academic at times, it's intended to give you some footing on what the heck is a valuation, what are they really looking at. So we're going to do some reality checks when it comes to that. And looking at your exact issues, those of you who responded saying that customer concentration is a challenge, management depth is a challenge, making sure you get fair market value is a challenge. We're going to go right at those today. This is intended to give you more than just insight. It's intended to give you a blueprint. And since Coleman does have about 90 minutes to 2 hours of material that he's shoehorned into an hour of 54 minutes of conversation, if at any point you have an idea, it pops in your head and you'd really like it covered or you'd like it answered, there is this chat function that, of course, you can take a look at, and I'll be monitoring that while Coleman is presenting. And if it's something that rises to the level of, hey, let's spend some more time on that, we will. So please don't hesitate about using the chat function for that. There's also a Q&A, and I can be in the background as the wizard answering your questions when you have a question that arises during the session. I'm going to hand this off to Coleman. He's going to take it away, tell you how to navigate valuation killers, and give you some drivers.
Right on. Thank you so much, Jeremy. We are super excited to be here. As Jeremy said, Coleman Swisher, I'm a certified exit planner, but I do not come from the consulting background. That's not been my path. My path has actually been in the trenches like you all, building a radiopharmaceutical logistics company. That's where most of my career was. And I led strategy development and M&A, was the CIO there ultimately, went from just a IT manager and then worked my way up to VP of strategy and then CIO. In that role, I did a lot of projects. I did a lot of digital transformation, did a lot of operational excellence programs, corporate development. And after I left, I was trying to figure out how can I take these skills that I've learned after these years of scaling the team at Associated Couriers and share them with the world in maximum impact. And so as I started looking more into the M&A space, which is where I was comfortable, we started thinking about, well, owners are always going to exit at some point. What can we do to provide value for them? And the obvious answer there for me was, how can we help them maximize the value of their company? And so as I was looking into this, I realized, well, these are all the skills and all this experience and all the projects that I have under my belt. And so what I want to show to you today is basically an operational framework for increasing the value of your business. How do you value a business? How can we put a formula and a framework around that? And then how can we systematically increase the value of your business in a formulaic roadmap process that can be tracked and measured? Coming from my background, I like being able to track progress, so this is really appealing to me. All right. So I'm going to start with reality check, some statistics. I'm going to throw a lot of statistics and a lot of numbers at you guys today. I'll try to point out the ones that are really critical, but I am going to send this to you, so you're going to have it to go back and review, because some of these statistics are actually really shocking. There's a nearly 100% chance that you won't be able to sell your business for the price you want. Some of you already know that here on the call, but it's worth mentioning. And in our current climate, 50% of business owners report planning to exit in the next 5 years. The big shocker, for me at least, was that 75% of owners who sell their business profoundly regret the decision to sell it within 12 months of the transaction. And so there's a lot underneath there to dig up, but the one takeaway that you need to have is the odds are stacked against you. Plan on when you exit your business, you're going to look back in 12 months and see all the things that you could have done better. I should have stayed on for a little bit longer. If I did this and completed this project, I could have gotten more money, whatever it is. Or I sold to the wrong person and I regret leaving my employees in that position. This is just really, really common as exit regret. 70% of businesses that go to market won't sell. 80% of the average business owner's wealth is tied to the business, so no surprise there. But also one other thing to keep in mind is that 50% of exits are actually forced. They're sudden. They were not planned. They call them the 5Ds: death, divorce, disability, and disagreement, as well as distress or burnout or overwhelm. So that's a 50% chance that when you end up selling your business or when the business sells, it will be because of a distressed event. So given all of these statistics, our purpose and why we're here is because this is the single largest wealth event for most business owners in their life. And beating these odds requires a lot of planning in advance. You got to have a strategy going into it. You've got to have a roadmap. You got to have a team behind you. If you're going in blind, or you're going by yourself, or you're going in not knowing what to expect, chances are you're going to be a statistic like everybody else. So we want to equip as many business owners with this knowledge as possible. Whether you work with us or not, I want to get this information out there. I want to share these frameworks. I want to share what we've learned and give you some tools to operationalize this, and you can start strategically planning as far ahead in advance as possible. So we train business owners to do just that, with the end goal of them being able to maximize their purchase price and controlling the timeline when they want to exit. We enable business owners to reveal regret-free exit options by unlocking hidden value in their business. So we'll talk a lot about hidden value today. And our promise is to transform your life's work into an enduring legacy that maximizes wealth and personal fulfillment. Every business owner's goal should be, when I sell my business, I get top dollar. I feel really good about the event. I leave a legacy that I'm proud of and that people remember. That's what we try to shoot for. So any conversation about the value of companies, we got to start at least at a foundation of how companies are actually valued. So we use the very simple formula. There's lots of different ways to do it. We focus on just adjusted EBITDA times a multiple. So adjusted EBITDA is recasted EBITDA. It's EBITDA with all of your personal business expenses taken out of the financials, and then it is multiplied by a market multiple. And we're going to talk a lot today about how that market multiple is calculated. For all intents and purposes, that market multiple reflects the value a buyer places on what we call intangible assets of the business. This can otherwise be called the quality of the business. So it's adjusted EBITDA times a representation of the quality of the business. Keep in mind, we're talking adjusted EBITDA, first of all, and multiple of the business. And we are not including debts, debt liabilities, or assets here. So we're not talking about anything that you can find on the balance sheet. That's not included in this formula, so keep that in mind. Back in 1975, we started to see a shift to this intangible value. And you can see here on this graph that that's been going up and up and up and up. And this graph only goes to 2020, but you can imagine that it's continued to go up. And what this means is that in the public markets, specifically with this graph, 90% of the value of businesses is wrapped up in this intangible capital, in this hidden value. And so what that means for us in the private markets, the same thing is true on a smaller scale, but depending on the size of the business, the industry, all of this, intangible assets are going to count for 30 to 80% of the value of the business. That's 80% of the value of your business you're not going to find on a spreadsheet. It's determined by the buyer, determined by the market. It's quality of the business. It's what are the appealing aspects of the business that make me want to pay top dollar for it. So quick overview of some logistics multiples. Take a quick peek, look and see if any of these EBITDA numbers sort of match in the range of the company that you're in. If I've captured the segment type of your company, I've got one number there highlighted in yellow in the middle because we'll be revisiting that later. But a couple trends I want you to see. First of all, depending on the segment, the multiple ranges are different, right? So in hazardous materials at the bottom, you've got a range of 6.5 to 9x, right? And those are the averages for each of those EBITDA ranges. So you can have a $5 to $10 million EBITDA business that's worth a 7x, an average is a 9. You might find a 10x that's a premium business. But different segments will have different value, and that's determined by the markets. It has a lot to do with what are the barriers to entry and stuff like that. The other trend to see is the bigger the business, the higher the multiple. The smaller the business, the lower the multiple. And that's because the smaller targets or the smaller businesses to buyers they have a higher perceived risk and limited scale, and larger companies, get premium valuations because they're bigger, they tend to be more diversified, they have professionalized operations. One note that I want you to keep in mind here is that this is representation of businesses that actually sold. This is 2024 transactions, okay? So, like I said, there's 70% of businesses that went to market last year and did not sell. So these numbers are actually skewed higher, okay? So a lot of the businesses that don't sell is because the owner's not getting the price that they want, or buyers are not appealed. They don't have an appeal to the business, so they don't buy. So keep that also in mind. Gonna get a drink of water. Okay, so I mentioned intangible capitals. Let's dig into what these are. We categorize these in 4 different segments. Okay, so that hidden value, that je ne sais quoi of the value of the company, we break it into these 4 categories. And everything related to intangible capitals can be found in these 4 categories. So customer capital relates to just the strength of your customer profile. Do you have a diversified customer base? Do you have a strong relationship with them? Are they sticky customers? That type of thing. Do you have customer contracts? Human capital refers to the people that are in the business. These are qualities like, do you have management experience? Do you have a system to recruit, retain, and grow talent within the organization? So overall, what is the aptitude and skill set and knowledge of the people in the organization? What is their capabilities? Structural capital is really the big one here. It outweighs all of the others by far. Structural capital is it's the engines of the business. It's the guts of the business. It's the things that run the business, where all the data goes. It's processes, it's systems, it's documentation. It's the things that make your business scalable, making sure that the trains are running on time, okay? Things like accounting processes. And social capital is the more nebulous one, but it's still really important. It's what's the culture of the organization, right? Are people motivated? Are they excited? What's the drumbeat of the organization, the rhythm? Is there innovation? Do people communicate well? Is there a good vibe? Do employees have good relationships with one another? So we break them down into those 4 categories, okay? So those are the assets that are driving the value of your business. Beyond that, at Boulder Futures, we have another 4 categories, and we use this as a way to explain what it is that makes premium businesses. And so these aren't necessarily assets. These are qualities that you'll see in premium businesses, okay? So 4 categories. A premium business has operational independence, okay? The business runs without the owner. The owner can look away and the business keeps running, right? This is similar to structural capital. It's similar to, human capital, but having autonomous vibe within the organization, that the trains run on time without the owner having to be there every single day. Growth capacity. Do you have a trajectory to grow? Do you have strong sales and marketing engine? And on top of that, do you have the capacity for it? Like, can you scale? Like, if you bring on a bunch of customers, can you actually handle servicing those customers? Strategic clarity is, do you have a documented strategy? Are you setting goals? Are you following through with those goals? Does the team know what they're supposed to be doing on a day-to-day basis without oversight? So more on strategic clarity later. And the last one is risk resilience. This is what the buyers look for, right? In every deal, when they come in and you're looking to buy a business, the first thing you're going to be thinking about is where's the risk, right? Are there legal liabilities? Are there employee law liabilities I need to be worried about? Are there safety measures? Are there customer contracts in place? What's the likelihood that a big customer is going to leave? So these are the four qualities of a premium business. They have strong operational independence, strategic clarity, growth capacity, and they are resilient to risk. The big question is, if the owner stepped away for a year, what would happen to the business? This is the gut check, right? You know that you have a premium, high quality business that buyers are going to be interested in buying. If the answer to the transferability test is that the business will continue to grow or it will, have explosive growth. Flatline is great. Most companies, though, if the owner walks away for a year, that business is not going to do so hot. Okay, so this is a good proxy. Now that's literally most businesses. That's the gut check. Okay, so now that we know a little bit more about intangible capital, we know more about the qualities of a business, what buyers are looking for, what buyers pay a premium for, and we're going to work our
Hey,
way down all the way to value
Coleman.
killers. Yeah.
Coleman, before you go too much farther in transitioning, there's a question that Eric had about the multiples that you were sharing. And so he had a question on, are those multiples based on optimal conditions? Can you speak to that real quickly before you transition over to the roadmap?
Yeah, let me go back to it. Based on optimal conditions. If I'm understanding the question correctly, what I will say about this chart that I pulled from 2024 data from GF data is that this is of the logistics companies that sold last year that had between $500,000 and $1 million in EBITDA. The average multiple was 5.3, right? For dry van trucking, for example. Yes, there were a bunch of dry van companies that sold for a 4x or a 4.2, and some that sold for a 6.5 or a 7. But the median, the average was that. So that's optimal conditions. I would just say last year was a really, really good year for transactions. It was a really hot market. In fact, a lot of average companies tended to stay out of the market because they saw how good the market was and they were like, let's do a few more
Stay
things.
in.
Let's tweak this up and
Yeah,
we'll make more money if we sell next year. Did that answer
great.
your question?
I think so. We'll find out.
Yeah. Okay. Creating a roadmap. Like any good plan, you start with capturing your baseline. Okay. Where are we at today? We have a test for that, and I'll share that with you later. The second step is identify your target state. Okay. There we have tools and processes to help you figure out what that is. But things like, well, when I exit my business, how much money do I want to make? Or how much money do I need for retirement? Or I'm going to be around for 10 years. Like, where can my business possibly go? Do you want to try to build a best in class business? And some people don't, and that's okay. But, if they're at a low end market multiple, they might not even be able to sell. So maybe they just want to get it to an average state. But where are we today? Where do we want to go? And then now that we have that, we can make the map. We can create the roadmap. We'll go through a checklist, an audit. We'll go through evaluation. Here are all the qualities of the business as they are today. And for the target state that we want, say a logistics company that sells for a 7x, they have these qualities. And so we can map the things that we need to work on it in order to get there. And we think in a long time horizon here. So we're not talking next quarter or next year. This is, you can be a little bit visionary here. And the next step is to implement it. I emphasize systematically. The value is not created overnight. If it was, everybody would be doing it. Everybody would be, have a unicorn company and they sell and they go buy some islands to retire on, right? In order to do this well, you need systems, you need processes, you need everybody on board, you need training, you need everybody running in the same direction, ways to set and prioritize goals. You need ways to track and measure progress. You need ways to track and measure, are you on the right track? So this is a holistic roadmap to creating value. And so we at Boulder Futures, we'll help you guys with the first step. Just for coming on the webinar today, we're going to give you our 60 question business maturity assessment. And this is just 60 questions. Some of you are going to think that's a lot of questions. Some of you are going to go, that's not enough, right? This is just an entry-level tool, a gut check. But the way that I want you to go through it, if you fill it out, you're welcome to, and you're welcome not to. But as you go through and answering these questions about the business and the qualities of the business, you score it like a buyer. I implore you to score it like a buyer, because that's going to give you a more realistic and accurate picture of what a buyer is actually going to value your business as. So if you're answering these questions and it says streamlined accounting processes, close the books within a week, and you're like, we're pretty close, score it a little bit more. I'm going to give it the benefit of the doubt because we've got an accounting project going on. We'll be there in 6 months. Like, don't do that. Look at it like you're a buyer trying to chip away at the price at the negotiating table. And what this is going to do for you is it's going to give you that lay of the land. It's going to give you that current state, that baseline, and it will reveal all of the, not all of them. It will give you a few. There's 60 questions. If it was a real business valuation or real engagement with us, we would be much more comprehensive. But it'll be a gut check. It'll be a high level. Oh, here are some of the weak points of the business. Here are the strong points. Then you can start to map the range of value that you might be able to get for the business. So if you score, say, 40% on the business maturity assessment, that's okay. That's not necessarily a low score. It's close to the average, as a matter of fact. But now you can map it to that EBITDA range for the market multiples for companies of your size and industry. And so this is kind of like the first step of creating that roadmap. And the beautiful thing about this is if you complete an assessment like this every quarter or every 6 months or even every year, you'll be able to actually track the value of your business in a quantitative way with historical data. You'll be able to see if you're trending in the right direction. So our business maturity assessment, this version, has 12 intangible asset categories. I know I said that there's 4, but we break them down even further, give you a little bit more of a nuanced perspective, a little bit more detailed. So I'll just run through these really quick because we don't have a lot of time. Business owner dependence and transferability is a category of questions. There's questions about the customer base, the relationships, diversification of the customers, some questions about the management team and the employees at the company. Financial performance, financial stability is a big thing that buyers are going to look at. So we have questions in there. Your positioning, your competitive positioning, your systems and processes, are those buttoned up? Do we have those? Are they documented? Are they automated even? What are the growth potential and buyer appeal? So we've got a few questions in that category. And another big one is brand reputation. So a lot of the intangible capital, especially the bigger companies, is wrapped up in the brand of the organization and the reputation. They're, big brands, they're recognizable, they have a reputation. So the bigger the company is, the more important that is. And the last 4 of the 12, we're going to ask technology questions. We're going to ask about any innovations, intellectual property that you might have. Most companies don't, that's okay. And then also some questions about risk mitigation, legal, and then we'll get into the heart of culture and organizational energy. So those are the 12 categories that are broken down a little bit more. And what I want to emphasize today, if you take nothing else away from today, is I want to convince you that a value building strategy is good strategy. Now, if you had said this to me 5 years ago, I'd have been like, what the hell are you talking about? That's crazy. You're not actually a strategist. That's corporate stuff. That's what somebody in M&A or an investment banker would say, just looking at the value of the company and not the actual strategic value of the company. Now, as long as I've been working with this, it's just clearer and clearer to me every year that this is good business strategy. Guess what? People pay a lot of money for really good businesses, for strategic businesses. They pay money for great businesses. If any of you have read that book by Jim Collins, Good to Great, that is essentially a value building strategy. And so now that we have a way to measure that value, a way to conceptualize it, a way to think about it, a way to systematically attack it, we can get really good at building value. This is so effective, in fact. And this data, I didn't pull it out of my butt. Okay. This is from research over 50,000 companies, 20-year period. And on average, when a company adopts a value building strategy, and this is a rigorous value building strategy, it is rigorous. After 2 years, the average increase in overall valuation is 71%. So if I told you today, like, hey, your business today is worth 10 million bucks, but in 2 years, it could be worth 17 million. That's a pretty appealing proposition. And I'm not trying to sell me. I am just trying to sell actually adopting a strategy that at its core is a value building strategy and taking it seriously and implementing it with rigor. And I can talk about what that rigor looks like later. The other thing about this is that this strategy compounds, right? Where other companies are out there and chasing sales, which is great, and they're watching their margins, which is great. It's phenomenal. That's fantastic. There is a level beyond that. There is a level up. And as you start really focusing on building value and seeing this happen, let's say each year, the increase in value 1 year after another is a lot more when you're actually focused on value. And then the next year is a lot more than it otherwise would have been. So it compounds. And so it's not uncommon after 2 to 5 years to see the value of a company double or triple. I have lived this. We have a case study on our website from the past that was about 3 years, and we 5x the value of the company. Now, at the time, we didn't realize that we were doing a value enhancement strategy, but that's exactly what we were doing. It was like 70, 80% looks exactly the same. We just didn't have the formula, the framework. And then long time horizon, 5 to 10 years, you're looking at 3 to 5xing or more, just even as an average. Really, really powerful concept, really powerful returns. I'm going to do a check on time. Okay, so like I said, I've got a lot to get through here. It looks like I'm only halfway through my slides. So I'm going to start skipping around, talking faster, just kind of skim some of this because I do want to get to the end where we'll actually see this in action. The blueprint overall, it is, I've kind of alluded to this, it's start with why, right? Why are we doing this? Bring in your team, figure out where you are, where you want to be. And then from that why, from that vision, then build the system, right? And that system comprises of using these strategic frameworks, using goal setting frameworks, using value tracking frameworks. But I want to talk about the second half of this, which is interesting because it's not what I would have expected. I'm sure it's not what you have expected. But the first order of business when you take on a value building strategy is to de-risk the organization. I would want to go directly into strategic execution, but we actually want to de-risk. We want to say, where are we at today? Let's make sure the wheels don't fall off. Let's put those wheels on and let's make sure the car doesn't catch on fire. Let's change the oil, all this stuff, de-risk first. Then you can get into more strategic initiatives, building intangible capital up. And then you're going to get to a point where the engine is built, it's humming, and it's just time to scale and it's time to grow. And companies who have been doing this for 3 years, 4 years, they're really get to that point where it's just a matter of, okay, now sell, 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 sell. This is to do this effectively. Highly recommend. In fact, I would say it's a requirement to have annual and quarterly goals that are ambitious. You're every single quarter, you're doing the reveal stage, you're collecting data, you're gathering feedback, you're getting a lay of the land. It's very comprehensive. Then in Reimagine, you're aggregating all of that information, you're plugging it into the value formula, you're systematically prioritizing these projects based on value to the company, and then crystallizing those into measurable goals, and then executing with discipline and making sure that you're tracking the progress on those goals. And I know all of us have gone through a goal setting initiative and we start and then we fall off the wheels. That can't happen if you really want to take your company to the next level. Built to exit. When we're building to exit, What ends up happening is you control the timeline. You don't have to, if you go engage a broker right now, they would love to get you sold next year. And you control the timeline also because if you are forced to exit for whatever reason, you've already done the value building. You know that you're going to be able to sell. You know you're going to get top dollar, and you're in a much better place than a lot of business owners are. So I'm going to skip through here. Yeah, the valuation gap is bigger than you think. And so we'll run through some numbers here. But the point that I want to illustrate is that most businesses that are out there are not at that average multiple for the industry. Those representations are for averages are for businesses that actually sell. 70% of them don't. And so that drives the actual average multiple of businesses down lower than we would expect. And so it's really common, and it's not a bad thing. It's just they're still great businesses. They're run, they're growing, they're kicking ass. But from a buyer's perspective, they want to see a little bit more. They see risks that we may not even see as risk. But they might go in thinking, I want to get a 6x for my company, and then they go to the market, and the market says, nah, it's worth a 4. For a $2 million EBITDA company, that's a big difference. That's a difference between an 8 multiple and a 12, right? And so for a lot of businesses also, once you get into that really low value range, buyers, they just might not touch it. They might not be interested. You might not be able to find a buyer, be able to sell it all. And so especially when there's a forced event, a lot of businesses are forced to liquidate. And I don't have that number off the top of my head, but it's higher than I would want it to be. Okay. We went through these numbers, but I'm recontextualizing them. 50% are forced exits. Average business owner, 80% of their wealth is in the business. 70% of these businesses won't sell. And then the other key statistic here that just for the market perspective is that 50% of businesses are still owned by baby boomers. There's a $14 trillion in assets that are going to be handed over in the next 10 years. They're calling it the silver tsunami, but it's really the baby boomers that are at the greatest risk, right, for this happening, where they haven't been building value. They're thinking, I'm going to exit in 2 years, and then something happens, right? And they're forced to exit. They don't get the price that they want, or they can't find a buyer. They might be forced to liquidate or sell it for pennies on the dollar. And that's a travesty, right? They've spent their life building the business. They should have the exit that they deserve.
This is apropos somewhat of what you're talking about. And I know you have a lot to get through, and we're actually on our first value killer, which is the promise of this entire proceeding. Eric's got a great question, though. He says, can you talk about the ideal conditions to be paid one transaction versus over time? So is there anything around that question that you can reframe when it comes to when you've talked about this is how, you could build better flexibility or give yourself options when it comes to your exit? What are the ideal conditions to be paid one time versus overtime?
Yeah, and that might be beyond really the scope of this conversation today, but I ended up skipping over that. So I'll come back to it real quick. The point here, as you're building value and the company is getting to that point where if you go to market, you're definitely going to be able to sell. You're definitely going to get the price that you're expecting, maybe even a little bit more. You're in a lot more control then. Because at that point, you can do whatever you want. You can keep doing the value building strategy and not exit. You could exit. You don't have to. You could keep going. You could keep going another 10 years. You could stop the value building activity for a while. It just gives you options. But when you're in that stronger place, now you're actually, once you start getting into those more above average and premium value ranges, now you're in a strong state to take on a buy and build strategy. You can start going looking for acquisitions to bolt on because you have the systems, you have the processes, you have the team, you have the brand, you have all these things, and you just bring that company in and integrate them. And you'll be able to buy companies at a lower multiple, integrate them into your company. That is the whole buy and build strategy is, buy low, integrate them in, and then they naturally become more valuable just simply because of the size of positioning. You can also exit. You could sell partially. You could sell to partners. You could sell to employees in an ESOP, or you've worked on making the business run without you. Now you've got independence. You can step back. You could just be a passive owner and just check in every once in a while, enjoy the cash flow.
Right.
Or
Either
you could
way, it sounds like your answer is really just that giving yourself the options is what is the ultimate ideal condition,
sit.
whether that means being paid one time or being paid overtime. Right.
Yes.
Keep
Thank you.
running, man. I know you got a lot to get to.
All right. How are we doing? 15 minutes. Here's what I'm going to do. I'm just going to run through these. I'm not going to go read through each slide. I did you one better. I didn't give you 4. I gave you 5. And then I also gave you the top 5 value drivers. So we've talked about it a lot. Owner dependency, that's the biggest killer of valuation. If the business is super dependent on the owner, buyers are going to run. Poor financial controls. I just talked to my friend a week ago, and he said that he's taken 3 sellers to the LOI stage, couldn't get them there because they just had such messy financials. They couldn't pull their tax returns. There was no way for him to even know if the numbers they were telling him were accurate. He had to walk away. So that's a major killer. Customer concentration. When you have 1 or 2 big customers that are responsible for a large portion of your revenue, buyers look at that and they go, if I buy it, that owner walks away, maybe the relationships with that buyer, something's going to happen. If that customer walks, then I'm hosed. And so rightfully so, that makes buyers nervous. Outdated technology, when they come in and it's just antiquated systems or no systems at all. We're in the technology era. A lot of companies still have not gone through their digital transformation stage, and it's a ton of work. It takes a lot of time, and you're missing out on your competitors have the advantage over you in terms comes to speed, quality, visibility, cost, all of those things. And the 5th big value killer is compliance issues. Businesses that have outstanding legal issues, or they have legal liabilities, or their insurance is not comprehensive in the way that it needs to be. There's DOT violations that are out there. We have our DOT compliance rate is at 85%. All of those little things, the tax liabilities, accounting malpractice, whatever, I can lump all of these into compliance issues. And those can make a buyer walk away really quick if they go, well, there's a lawsuit coming my way, right? Or a fine from the government. On the flip side, what are the biggest drivers to business value? The number 1 is growth trajectory. Buyers love to see businesses that are growing at a steady clip year over year above the market average, growing businesses. Financial performance, it's a big driver of value. Just really solid fundamentals, cash reserves, consistent profitability, margins above industry average. I said I was going to read through them. So 3rd biggest one, management depth. This depth is the strength of your management team. If they come in and the owner's not there, are they going to be able to run this ship? Revenue quality. Do you have recurring revenue, and do you have a diverse customer base, right? That reduces risk a lot, and buyers love to see that. Everybody likes recurring revenue. And the 5th driver, just as it's a killer if you don't have it, it can be a value driver if you're ahead of the market when it comes to technology adoption, right? Advanced TMS, if you're a data-driven company, you got all sorts of reports, everything's integrated, everything's streamlined. Buyers love to see that because obviously it's super valuable. All right, so we are in a good place.
Well done on that cadence, man. I love it. Finishing off with logistics and space. That's perfect.
Right. Yeah. Oh yeah,
Keep
I
going,
forgot
man.
that I put that in there. You can't have a slide about technology and it's not a bold
Without going to Mars. Right.
presentation without an astronaut. But yeah, let's look at what this looks like in action. So tried to put together, Michael is somebody who's in our industry. He's a fake character. He's an archetype of most of the owners in our industry. It's been the owner for a while. It's a good company. It's established, got good customers regard them well. Employees like working there. They've been tenured. So he's got 26 million in revenue, 2 million in EBITDA. So close to 8% EBITDA, which is about market average. And I forgot to mention that this is meant to change this. I've got it. Final mile shipper. He's got some long haul trucking and some warehousing. So he does a little bit of everything. 26 million in revenue, 2 million in EBIT for a $9 million valuation. Okay. So if you remember, for Michael's revenue range and for his segment, the average multiple for businesses that are sold is 6. So he's not been in the market yet. He could assume that it's a 6, but after getting a valuation, after going through everything, it's more likely that if he went to market right now, he would get a 4.5x. Not a bad company, but he wants to grow it. He wants to get it into a better place. He's looking to retire in 5 years, sell the business. So he's taking this seriously now. So he adopts a value enhancing strategy. He knew that this was going to be a transformational effort. Things needed to change from the inside out. His team is not used to structure and discipline and accountability and projects and change. Is a transformation effort. There's a lot of change that happens, and it can be disruptive for the first year as people are getting shocked and hit which way with all the changes. They're getting whiplash, but slowly they start to acclimate to it. And then before you know it, it's just how people operate within the businesses. This is our cadence. This is when we meet. This is what we care about. This is how we track it. This is how we act. These are the standards we hold ourselves to. And so he went through that transformational effort. I kind of jumped ahead of myself. I probably shouldn't go through these, but I have them listed there as descriptions of what his company looks like from a capital perspective, intangible asset capital perspective. But overall, here's his score for each of the capitals, right? An average would be around 45 to 55. He's slightly below average. He's a little under 40%. And so that's where we mapped him down to that 4.5 multiple. Here's the quality of his business, right? How the business looks and operates and feels. There doesn't feel like there's a lot of strategic clarity or a lot of operational independence. Michael is in there every day. He's working on vacation. He's an email warrior. He's calling customers all day. He's the only one closing sales. We talked about strategic clarity, growth capacity, risk resilience. Long and the short of it, so I can get through this presentation, is that not bad, not great, little below average. And so he takes on this transformation effort. The first year is really rocky. They're instituting all these new processes and new drum beats to the organization. The culture has to start shifting. There's chaos at first, but after the first year, everybody starts to get used to it and they start to like it because they can see the progress that they're making. They can track their accomplishments. They can look back and they can see, whoa, look what we just got done this quarter in this past year. And so the first thing he did was he de-risked the organization. He cleaned house. He got everything organized. Then it was all about systematizing operations, right? Now that it's organized, let's create some systems around this organization. And as we're creating these systems of organization, let's start delegating these things out to other people. Now they own the processes. Now they own the relationships, not Michael. And so roles start to form. Documents and SOPs start to come about. Processes for making sure that KPIs are being hit on a weekly and monthly basis, and people and teams and departments are held accountable to it. Then everything is digitized. He already had a TMS, but he really leaned into the TMS and started using more of the features that they weren't using before and trying to get value out of that, capturing more data, providing more value to customers in the form of visibility and customer portals, adopting fleet visibility and IoT where needed. So it all culminated into this sort of digital transformation for Michael, which is really common for a lot of businesses that go through this value acceleration methodology. But then once we get to that point and we have all this organization, streamlined processes, everything's digitized. Now we have all of that captured as data. Now we can track and measure all of that data. And now it's all about operational excellence, making sure that we're hitting KPIs, we're doing processes to the extent that we need to be doing them, right? So now we can track the sales pipeline and we can follow up with leads. Now we can track profitability by customer and we can make sure that that's on track. We know when we need to do price increases on customers. So there's a lot more visibility we can manage via the data. It's in a better spot. And now it's just in time to grow. And so by the end of 2030, as he went through this entire process, this is the end state for Michael. He grew at an average of an 8.5 compound annual growth rate, which is what the projection is for final mile. Where he ended with that is 39 million in revenue. So he added 13 million in revenue. He added 50% to the top line. And that's not aggressive sales. That's just keeping up with the market. Okay. But as a result of all of this organization and transformation, his margins naturally improved because he was able to service clients better. He was able to track the data better. More things were automated. And so his EBITDA margin naturally improved. So because of the revenue growth and that EBITDA margin growing, he more than doubled his EBITDA over the course of 5 years. And with all of this transformation, he went from a 4.5 baseline multiple to actually a 7. An average company in that segment would command a 6, but he ain't average anymore. Now companies are trying to keep up with him, and that can happen in a value acceleration model. You blast past your customers because you're taking this seriously. And so this new calculation we have here is, that over doubling in EBITDA and a higher multiple, the value of his company exploded. It went from 9 million to 31 million, which is 3.5 times what it was 5 years previous. And so now that he's at the end of 2030, and he's added $22 million to his exit option, he doesn't have to exit if he doesn't want to. He could keep going if he wants to. He's got perpetual optionality at this point. Maybe he's like, you know what? I'm having a lot of fun now. I'm in the game. I'm going to do some acquisitions. But he's got the options and a much more enjoyable retirement. I wanted to also go through the business as usual scenario, which is not bad, right? The norm, it's the average, it's what everybody is doing. But let's take what we just saw and compare it to a baseline. And I'm going to also give Michael some credit here. He knows about value acceleration, or he learned about it in 2025. He kind of understood a little bit about, the things to do, just didn't really tackle it like in the previous scenario. So where he would end up with that is a slight increase to the multiple, right? He had the same compound annual growth rate of 8.5%. And this is where it landed him. I'll just skip ahead to about 16 million in revenue, which is still great. Like, the value of his company increased 75%, right? He added almost $7 million to his exit price after 5 years. But the difference is he left 15 million on the table, right? So the difference between a value acceleration methodology and not small, it's exponential. So I hope that I illustrated that here. As I blasted through it, I know I would have loved to talk slower and explain things a little bit more, give some more detail. But I wanted to put as much in here for you guys as possible so that you could have this takeaway. And so what I would posit to you as a takeaway for this webinar, thank you so much for being here. I really appreciate it. I hope you got a lot out of it. Pick an exit target, an exit year. It doesn't have to be set in stone, but if you have a number, like whatever, just 2028. Okay, now I can orient myself towards that. And as you can always change it. Now I want to do 2030, but pick a year so that you have something to work with. Take our assessment. I'm going to send this presentation to you. You'll click that download assessment button here and you'll get a copy. Fill that out. Then if you want, call me. We can go over it together. We can take a look at what, now that you have the assessment complete, you've got a score. You can see, each of the categories, where you're strong, where you're weak. We can kind of walk through like, well, this category looks like it might add the most value to your business, or this one is the most immediate, or, I can help provide some recommendations around where the most hidden value is and the most immediate hidden value. So there's a call button here as well. This will take you to my Calendly. Just throw a time on my calendar. We can hop on. We can chat about it. Yeah, I would love to meet you guys, because most of you I have not. And then the fourth thing is, I hope I equipped you to change your future just a little bit. The odds are stacked against your favor. So even if you don't take a value acceleration methodology, now you can at least take this framework with you. And 5 years from now, who knows where you'll be, but I don't think you're going to be in the 75% of owners who profoundly regret selling. So that's all I had for you guys today. I truly appreciate you hopping on. Come check us out at Boulder Futures. We're on LinkedIn. And Jeremy, I'll turn it back over to you.
No, grateful for everyone for sticking in for the presentation. We had everybody really stuck around today, and I know that that's a challenge when it comes to our busy lives. So thanks for taking time out of your day to get serious about building valuation in your business. Look forward to a message from us with a wrap up of all this material and something you can execute against quickly. So getting that assessment will start to put you on the road. It'll give you the pathway, rethinking what valuation strategy looks like in your business. Great job, Coleman. I can't even razz him in front of everyone. Thanks for listening to two bald white guys about helping to transform your business. We appreciate it. Looking forward to talking to you more.
Thanks, Jeremy. We almost called it Balder Futures.
Balder Futures, right. We at Balder Futures know how to give one haircut, so we have that as a fallback plan. But appreciate everyone for your time. We're going to wrap up this session. Please do grab some time on our calendar, and we'll look forward to talking to y'all soon. Something I did forget to mention, we will have a follow-up session to this one, so you can also look forward to an invite to our follow-up virtual session on taking a look at the future of logistics. So as you are taking a look at your value, we also want to take a look at the horizon so that way you can create a strategy that's forward-facing, so you can appeal to that premium buyer and say, not only is this thing hitting all the cylinders for everything you're looking for, it's calibrated toward tomorrow's customers, and we're taking a look at where the industry is going. And so our strategy has that baked into it, and it gives them something exciting, the market. So thanks y'all for coming. We'll be in touch really soon.